Hello and welcome back to the next video in the FX Evolution trading course. Today we'll be diving in and taking a look further at candle patterns, specifically candle patterns that are to do with the end of the trend and a start of a new trend. These can be great for us as technical traders because they can signify great places where we can analyze the markets and take profit in our existing trend, and it can also signify great entry points for us when we're looking and analyzing the markets for potential change in trend. So let's begin by taking a look at 4 different types of candle patterns: the inverted hammer, shooting star, morning star, and evening star. The inverted hammer and morning star are both bullish candle patterns. So this means that we've had a bearish or downward trend, then we've seen an inverted hammer or morning star, and this is our signal that trend could be reversing to the bullish or upward side. The shooting star and evening star are the direct reversal, so they're bearish patterns. And what this means is that we've had a bullish trend or upward trend, then we've seen a shooting star or evening star, and these are signifying the beginning of a bearish or downward trend. So let's begin by taking a look at the inverted hammer. Here we have a series of bearish candles followed by a green bullish candle down here with a long wick or shadow. This green bullish long wick shadow candle is the inverted hammer, and it signifies the potential change in trend. It's important to note that when correctly analyzing inverted hammers, the up shadow needs to be more than twice as long as the body. So the long wick section here needs to be at least twice as long as the body section. Now, when we're understanding an inverted hammer, what it really signifies is that price is making a change of trend. So we've had the bearish candles moving in where price is steadily making new lows. Then during this candle, price has opened up and generally moved to a higher or upward, so bullish movement or a commitment of the buyers. And then near the end or at some point during the candle, price has then begun selling off but been unable to close to a new low or a red bearish candle. And this means a fundamental change from the sellers being in the market to more buyers potentially being in the market, and it can very easily signify the change of trend and the beginning of that bullish upwards trend. I like to personally wait for the next candle to open up bullish and close before I enter the market, as that's my further confirmation. But some people just use this as their confirmation of entry. So let's take a look at an inverted hammer example. This is the Swiss franc Japanese yen daily chart. We can see down here we've had a strong downward trend followed by actually 2 inverted hammers after each other. You can then see the trend changed and we had a series of bullish candles afterwards. Now, it's important to note that any of these candle patterns can be used on any time frame. So whether you're a 5-minute trader, 1-hour trader, 4-hour trader, it doesn't matter because we're analyzing that time frame, and candle patterns are about analyzing that time frame. Let's now take a look at a shooting star. We can see a shooting star occurs after a bullish trend. So we've had a series of green upward candles, and then we've got an open here where price has gone up and moved higher and then been unable to hold the higher level and then being sold down all the way through that candle to end bearish or downwards. So again, in this case, it's the up shadow needs to be more than twice as long as the body, and this signifies a fundamental change in the market. So what's happened during this candle? Basically what's happened is that price has moved higher and the bullish sentiment has continued during at least some part of this candle, let's say 1 hour. But during that 1 hour point, the buyers have lost commitment and the sellers have taken control and pushed it from this extreme zone all the way down so that the candle closes at a new low. It really signifies that price has probably hit an extreme level and that everyone that was bullish is now taking profit. So the hedge funds, big banks, all of those kind of people that are trading, and us as technical traders may have been looking at that level as a critical level for us to take our profit off the table and then potentially start selling the market, which is what's happening during this candle. It's a really strong candle for signifying the end of trends, so always look out for shooting stars in the market. Here we have the odd Japanese yen 4-hour chart for a shooting star example. And we can see up here, we had a bullish trend followed by a shooting star and the beginning of a bearish trend that looks likely to continue. For a morning star reversal pattern, let's take a look at a couple of key characteristics of a morning star reversal pattern. This is a bullish star reversal pattern, which consists of 3 candlesticks. The first part is a large bear candle, the second part is a small candle with the gap down, and the third part begins with the gap up and is considerably large bullish candle. So in practice, how does that look? Here we have a morning star candle, and we can see that we've got bearish candles coming in, the bearish candle down here, followed by, at the close, an actual gap in price. So price has opened up even lower after the close of this candle in that split second or day or whatever type of chart we're looking at. And then it's opened lower and ended bullish. So there's been a commitment by the buyers during this to actually buy up the price and end slightly bullish. Then the next candle opens bullish, but you can see that price again gaps up and then closes as a bigger candle. And this is the important one we really want to focus on, because you can see that this bullish candle, after this little one down here, has opened up and basically engulfed the previous bearish candle. So it's basically cancelled out this bearish candle and this gap and signified the beginning of another trend or bullish trend. Let's take a look at it in an actual example. So we can see here, this is the 1 minute Singapore dollar Japanese yen. Price is bearish and moved down, then price is gapped for the next minute opening down, and it's not perfect, so this should generally be a bullish candle, but prices opened down on the gap, then rejected this point and just closed. So as long as this candle's small and it's sitting there and price isn't moving too much, generally that's fine for Morningstar patterns in real world examples. We can then see that the next candle has gapped up and closed incredibly bullish. So it's basically engulfed the previous 2 candles and prices ended up bullish, and this can signify the change of trend like it did here, and price then continued upwards for the next coming candles. Then we've got the evening star reversal pattern, which is a series of bearish star reversal patterns consisting of 3 candlesticks. The first part is a large bull candle, the second part is a small candle with a gap up, and the third part begins with a gap down and a considerably large bear candle. So in practice, it looks like this. We've got a series of bullish candles. This is the one we need to focus on. And then we can see that at the end of this particular candle, price is gapped up, opened, closed bearish, so closed down. And then after this candle is closed, the next candle opens up bearish and then closes down. After we've seen this confirmation of 3 candles, we can be pretty sure this is the end of a trend, at least based on the candle pattern analysis, and the beginning of a new trend downwards. So we begin at the end of this candle, we'd short or sell the market with the idea of profiting from a decrease in price. Just a top tip that I always like to look at is that I like to have pending orders just under the close to avoid any kind of fake candle analysis patterns. So let's take a look at the evening star pattern example in the real market. Here we have the Singapore Japanese yen on the minute chart. We can see the price has moved upwards over time, a bullish candle has occurred, then we have a bearish small candle here, and then we've got price gapping below and closing to the low. So you've got the gap here moving up, which is the important part. So a gap after the bullish candle, and then a gap after the bearish small candle here, followed by a bearish candle overall. And this is usually a signal of the end of trend. The bigger the time frame you find this on, so let's say a daily chart, the more the change of trend and the more people that will see this. And it can be very powerful if you see the correct setup occur. This concludes the video for today, and we'll see you in the next video.